Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
If you are a tradesperson or in the trades of real estate, this is an episode you want to pay specific attention to. We're going to talk about going from construction and contracting all the way up to scaling a huge multifamily portfolio. We're going to talk about how operational efficiency forces appreciation in multifamily with my guest, Jered Sturm of SNS Capital. And this all takes place in Cincinnati. So if Cincinnati is a market that you're interested in, we've got a great show for you. And it's great either way. Let's go. This is episode 155 of Zen and the Art of Real Estate Investing with my guest, Jered Sturm. Jered is the co-founder and CEO of SNS Capital Group. SNS Capital Group is a private equity investment firm specializing in creating wealth through real estate with a focus on acquiring and operating large apartment communities. That is multifamily. Jered, welcome to the show.
Thank you, Jonathan. I appreciate you having me on and giving me the opportunity to share a little bit about my story.
Yeah, and the story is really what I like, and I think that's what really connects with other people to help them on the journey. So let's start at the beginning of yours. When was the first time that you remember thinking real estate was going to be something big in your life?
Okay, well, it goes back to high school. So I was not the best academic student, but I was very good.
Same here.
I was very good in wood shop. And so, all the way through high school, I tried to spend most of my time in wood shop and kind of said I have a natural aptitude working with my hands and being in the trades. And my senior year of high school, our high school had a program where you could work full time if you had enough credits. So I signed up for that. I became a full-time maintenance technician for another apartment landlord in Cincinnati, Ohio, which is where I live today, and had the opportunity to kind of learn the business from the maintenance tech perspective. That was 2007, and then ended up buying my first investment property in 2008, and have fast forward 16 years now. We're at about 1,400 units here in Cincinnati, Ohio, and it's been a fun ride all the way through.
Yeah. From the maintenance side, what got you over the hump knowing like, hey, I can do this? Because you were young at the time too. And there's always that step where you realize kind of the light bulb goes off, like this is available to me.
Like you're saying, how did I know how to do the trades?
No, how did you know that you could buy real estate? Like when did it change from thinking you were an observer for somebody else to saying like, wait, I'm young, but I'm going to buy something?
I don't remember a profound moment. I think it was kind of like I was exiting high school. I wasn't on the typical corporate America path just because not being a great student kind of doesn't put you on that path.
Yeah.
But I was driven. I was smart. I wanted to work hard, and I saw my aptitude in the trades as, a potential competitive advantage in this specific niche, which was real estate.
Yeah.
But really the first property wasn't all that. I'll give you a little more context. Like it was a 6-bedroom house, single family house where me and my brother bought it. We lived in 2 bedrooms. We rented out the other 4. And really the only buying criteria for that house was that it had a 30 by 50 detached garage that we could run our, little construction company out of. But
yeah,
it worked out well, and it gave us kind of the roots that we've been building off for the next 16 years.
Yeah. So when you rented those other 4 rooms, though, did you rent to friends or did you throw it up on like Craigslist at the time? Because you're young, though, so you're kind of figuring out like the first time how to be a landlord. And now, of course, you're 1,400 units, a whole different story.
Yeah. No, I mean, we rented to friends, and I would say I've heard stories where that doesn't go so well, and I'm fortunate that that's not my story. So we ended up living in that house for 5 years.
Oh, wow.
With the same people, right? And
that's awesome.
It was a great opportunity to build lifelong friendships, and we learned along the way. And yes, there were some challenges being the roommate and the owner, but nothing that was too disruptive.
Yeah, I think that, since house hacking became so popular, I think that people forget about the single family room hack option with friends. I think it's a great opportunity, especially, in that 18 to 22 range. If you have the finances to get it, don't you want to live with your friends when you're that age? I mean, it sounds great.
Yeah, it was a blast. I mean, it was basically like a off-campus frat house,
Right. Right.
and it was a great time, and I wouldn't trade it for anything. But it also gave me a really good start from a financial means perspective because those four guys were really happy. I think at the time this is the Midwest, so Cincinnati, Ohio in 2008, but we were charging them like, 400 a room or something. And it was significantly, it was more than what the mortgage payment and kind of operating costs were. So we were living for free. And for 5 years that, I have moved out of my parents' house and had no living costs for 5 years. So that gives you a little bit of a running start when you go into the rest of life.
Yeah. I mean, with rates now that the way that they are, I guess it's a little bit harder for somebody to find that. But were you balancing the fact that you guys could probably do some value add, or was the house in decent enough shape to just move in and you guys are 18? Who cares? It all looks good when it's your own.
So I'd say there was that balance there of we did some renovations to help out with the whole thing. So example, we finished the basement and added 2 rooms. So originally 4-bedroom house that we put 2 bedrooms in the basement. So yes, we had that competitive advantage, but it was in not a good neighborhood, which wasn't important to us at 18 to 22 years old, all guys, right? Like it was an inexpensive house that allowed us to get in. So we could have, without that competitive advantage, we could have done it. We still could have done it. So I don't want to say that to the listener, I don't think you need to have that skill in the trades.
Yeah. And you were also thinking like, hey, it's going to be us all guys. We don't really need to like focus on the neighborhood super important or being close to something because you're trying to get in and build something and also just live on your own at an early age is pretty good.
Yeah. Yeah. I mean, it's like not only was, you could say like school districts obviously didn't matter to us at all, but I would say crime didn't really even matter to us that much. We were like, oh, they'll leave us alone,
Yeah. Yeah. Mind your own business and get it done. But over those 5 years, I'm sure you figured out the appreciation scale as you were going. And I wonder how that helped you, figuring out what you wanted to do going forward.
You mean appreciation of the asset? Or?
Yeah.
Yeah. I mean, you start to catch on to all of the benefits of real estate. And, at the same time, I was still working for that other landlord some. But to add to the story, we were both, me and my brother were maintenance techs for that landlord. And then that evolved into friends and family asking, can you fix this? Can you fix that? Can you add? And we would always just say yes, because we kind of had a natural aptitude for the trades. And if we didn't know something, YouTube could teach us. And that evolved into as far as high-end kitchens, bathrooms, putting additions on people's homes. And we were the ones swinging the hammer, doing all the work.
Yeah.
But at the time, again, this is like 2008 through 2011, there's this financial crisis happening and lots of foreclosures hitting the market. So what we were doing during that time is we would go do a, high-end kitchen for a homeowner, make significant profits, take those profits, turn around and go buy a very distressed single-family foreclosure. And then nights and weekends, we would be over there fixing it up to then ultimately rent it out. And so we did that for 3 years. And if you remember, 2008 through 11, no one was lending, especially to an 18 and 20-year-old who didn't have a W-2 job. So everything had to be cash, both renovation and purchase. Fortunately, in the Midwest and that time, things were inexpensive. So we could do that. And then, we bought the first 8 with cash. And then at I think 2, maybe 2.5 years in, found a little local lender that gave us a blanket cash out. And we made the wise decision to then reinvest that into more properties. And that's when the snowball really started rolling.
Yeah, that's pretty awesome. I mean, you're leveraging the skills that you have, like you said, and I don't think it has to be, trades or contracting or plumbing for somebody. There's always some skill that somebody can use, but I think everybody would be best served if they know a couple contractors or somebody who's good at a lot, handyman, because that's what you really need to do for just property maintenance. I'm sure as you started to get, of course, you're going to renovate these properties, but as you get to smaller apartments and stuff along the way, your knowledge of maintenance and how quickly you can get these things done, or just knowing what's wrong with something, probably gave you a huge advantage over just kind of your regular person who doesn't know much and buys an 8 unit.
Hmm. Yeah, I would say it's still, even today, buying, 100 plus unit apartment communities, it is our competitive
Yeah.
advantage. Right? And, today we have 50 employees, and our construction arm of our business is still in house. And so we have W-2 employees who handle our, $15,000 to $20,000 per apartment interior unit renovations. And, one of the KPIs that we track today is the time frame of when the construction starts to when the construction finishes, and we average about 3.5 days with those $15,000 to $20,000 renovations. And so,
Wow.
still, even today, across now we're doing hundreds of units every single year, and more than a unit a day, and we still kind of use that as our competitive advantage. So, Jonathan, one thing I say is, like, our business plan, our business model hasn't changed all that much from that. Those first houses, we buy distress. That distress usually comes in construction and property management. We force appreciation, we strip the equity, and then we roll it into the next one. And so we've just been doing that same thing in the same market for 16 years.
Yeah, I mean, I like the trajectory though of what you did, because you did 8 by cash on your own, like you're really betting on yourselves, and then you finally figured out a way, like, okay, here's the way to start using leverage to go up. When you went up, was it more units or bigger type of property? How did you get from kind of the subset of what you were doing to kind of going into larger scale apartments?
Yeah, I mean, it's a challenge, right? Especially if you're not raising money, which we didn't for the first 8 years.
Yeah,
So we were just stripping the equity, forcing appreciation, stripping the equity, deploying it into the next one. And you're right. Like, we started in single families, then it would be like some duplexes started coming in, and
Yeah.
then quads started coming in. And then it's like, you're snowballing. So then you have the means to be able to take down a 10 unit. And a big leap was when we bought a $2 million 42 unit, no investors. And to do that, we actually looked at, our financial statement and our balance sheet and said, like, we need some more cash to be able to handle not only the acquisition, but like the reserves and being able to operate this safely. And so what we did was we went out and used that same skill set and just flipped 15 houses in a year really quickly to generate some cash to then buy this apartment. So we're not flippers, but we used the skill set to generate some cash to be able to do it. So to answer your question, yeah, over those first 8 years, we were just, methodically kind of getting larger and larger. And it was that 42 unit where we kind of saw, like, we really enjoy the system, process, economies of scale of a 42 unit, especially in the renovations.
Yeah.
Being able to systematize that renovation process really aligned with who we are and how we want to run the business. And so we said, let's go do it in even bigger ones. And around 8 years into business is when we added on the idea and business model of raising money from outside investors to help us be able to do that.
Yeah, but when you did that, you had a great track record too of these other properties and of generating income and of turning the value add and getting better valuations. So I think it was probably easier for you. I mean, it's never easy to start asking for money, but at least you had this runway that you could show people like what you've done. Did that help, having those 8 years of success, just doing it all on your own?
Yeah, yes, a lot. And frankly, we didn't think, I got started so young, me and my brother did, like, we didn't think we would raise money from outside investors, but
Yeah.
over the 8 years, we did have people express interest, right? And the wise decision we made was to keep track of them. So, like, we were taking notes down in an Excel spreadsheet of people who potentially would. I think when we were doing that, I don't remember it distinctly, but I think we were thinking, if the banks dry up again, this would be something we could borrow money from, debt. And then we ended up, utilizing under equity. But that's why we were tracking that. But I didn't want the responsibility for the first 8 years. I think a lot of people jump into raising capital way too early.
I agree.
Because I had 8 years under my belt of my own school of hard knocks and making the mistakes, which we made lots of them and still make them today. But yeah, we were building out the infrastructure and property management arm of our business, the construction arm of our business, to be able to support the operation that then support the financial returns.
Yeah, I definitely worry for the people who maybe have a 2-family and then they go 15 or more. It's a little bit of a different beast. I mean, you going to 42, you guys had really pre-planned, you had the experience. I don't think you really, were you worried about it at all? Or did you know, like what you were saying, this is just a new economy of scale. We've got this. This is going to work.
Yeah. I mean, I'd say when we bought that 42 unit, we probably had 60, 70 units already, right?
Yeah.
In smaller assets. And so, no, it wasn't a concern for us.
when you get to that point, you have 6, it's actually easier, right, for you, because the more you can acquire at once, the more you can keep everything kind of in one spot. You're turning over, giving yourself comps on rents inside the same development that are going to help you grow that exponentially quicker.
Yeah, I would say there are sticking points, different unit counts, right? And so being self-managed, vertically integrated, building that company out over 16 years, there's different challenges at different phases. And there's also advantages at different phases, but you get into the 300-400 units and you have a whole nother problem on your hands of you have a lot of units, but you don't have enough revenue to support the organizational chart to have a fully professionally run property management organization. So you're wearing lots of hats and you're trying to also grow. And so we fought through that. And I would say for me, what felt like the biggest kind of transition point is when we hit about 800 units all in one market, because it supported an org chart of probably 3 tiers, being like on-site level operations. You have your leasing and maintenance as your entry, and then you have like supervisors, and then you have and property managers, and then you have regional managers. And really when we hit that 3rd tier of being able to have the revenue to support an employee in those roles, that's when there was a shift for me of like, this is sustainable without having to be me all the time. And, that took 12 years. Right. And so I think it was a long grind of hard work to get us there.
Yeah. And then when you get to that stage, though, you can pretty much add on any number in terms of acquisition and you'll be fine, because now your systems are really set up for the scale that you already have.
Mm-hmm. Yeah. And that's something I should give credit to my brother, who now holds the COO role in our organization. Is he's been very intentional about building the organization as if we were 5,000 units. So that way, when we get there, we're not caught off guard, right? And so we're not always settling to the number of units that we have. We're trying to be prepared for that growth.
Yeah, that's definitely smart. Hey, it's Jonathan. This is just a brief interlude to talk to you about Deal Machine. Listen, I've used Deal Machine and I was crushing it with my Concerned Citizen postcard on Deal Machine. You can look that video up on my YouTube and find out how I did it. It works. Deal Machine works. I've had David Lecco, the CEO, on the podcast. So if you want a free trial of Deal Machine, the elite Driving for Dollars app, and I'm telling you, it works if you use it correctly, you can go to my link at bit.ly/Zen Deal Machine. Now, bit.ly is bit.ly/Zen Deal Machine. It's free and you'll be up and running in 2 minutes, and then you can figure out if you want to keep it. Let's get back to the show. Let me give a couple questions about kind of, I guess, there's a lot of people who want to get into larger scale multifamily. Is there a number of units that you think is just too many for somebody who's maybe just has a couple properties? Like we go through this like a lot, what people think. I know from you guys, you had already done a decent amount. You have 60 units, you buy 42, you can handle that. But is there a number of units that you feel for somebody who's only owned residential properties, nothing 5 or above, that they should steer clear of on a first kind of bigger purchase?
No, I don't think I can draw the line in the sand. I think, it depends situation, and all of us have different competitive advantages and core competencies and networks. And so it just kind of depends. But I think doing it wisely is really important. So you need to be thinking through, what are my competitive advantage? Do I have the capacity to handle this? And my personal opinion is do it with your own money first before you start raising money from outside investors.
Yeah, I think that's great advice. And in terms of like unit upkeep, when you're buying in now at the larger scale, whatever it is, 50 or more units, are you looking for a certain percentage of units that are either vacant or need renovation so you can kind of advance that value add quicker?
Yeah, I mean, we are value add investors, but that's, too common of a phrase. And so I'd say the value add comes in many shapes and sizes. And for us, usually can be boiled down to 2 components. It's property management and construction.
Yeah.
And they come in different weights, right, depending on the asset that we're looking at. But I think everyone understands those of like, this is run not so great and we can run it better and squeeze the expense ratio down and juice the rents a little bit if we do renovations. Those are like, everyone knows that. And so those get baked into the pricing too easily. I think what we're really good at is having the years of experience and the boots on the ground operational knowledge that we see opportunity kind of between the line items on the income statement or things that don't even exist at all. And so that's where I think the best value add is the stuff that other people miss, because then you're not paying for it on the front end. And so I don't remember the original question you just asked, but for us, value add is like a lot of times the most beneficial when it's the small unnoticed things and lots of them added up.
Yeah. What can some of those things be? I mean, sometimes it's extra units that can be converted or extra space that can be converted for like more community environment, which then helps tenants better. And then your management is better. So everyone's happier. So the upkeep is better, right? There's kind of like the sliding scale of what you do as a manager for the building that can completely change over, I guess, the way that the tenants feel about the properties.
Yeah. I mean, I can answer that. I'll give you two different answers. One is pretty high level. Like when we look at a property and we're underwriting, and our 19 communities are quite similar. We'll call them like B class in Cincinnati, Ohio. We kind of know what it takes for us to operate these. Yeah. So at a very high level, I can quickly say like, they're operating at a 60% expense ratio. We know we can operate at a 43% expense ratio. So something in here is off and they're efficient. So let's go find that. But a more niche example, and specifically how it leans on my background in construction, I'll give you a real world example. A couple of years ago, we bought a 72 unit apartment community. The building was built in the 60s, and so it was run on boiler heat. 2 giant boilers in the basement fed all 72 units. But this was not radiant boiler heat. This was forced air boiler heat. So what the difference is like hot water pours over a coil, a fan blows over that coil and pushes air through ductwork. So the infrastructure of the ductwork as well as the air handler are already in the unit. And so what we saw when we walked it is like, well, we can just disconnect the plumbing that is running all the way down to these massive inefficient boilers that we pay for. We can install individual hot water heaters in every single unit because the panels had been upgraded and had the capacity to handle the electrical burden. And so for less than $1,000, we can add in essentially individual boilers to every single unit, which then passes back to the resident on the electric meter. And so that for us was a way to knock out a $50,000 a year gas bill, and I would say pass it back to the resident, but it's not a 1-for-1 pass back because what we were producing was more efficient and they are more conscious of their use, right? And so we might be shedding $50,000 in expense, but they're gaining $25,000 in expense as the resident. And for us, that's value add, right? Like no one else saw that because they don't have the background in construction. They were just underwriting saying $50,000 gas bill, right? And assuming they were going to inherit that, where we built it into our model to say, no, we'll spend $72,000 in CapEx to upgrade this and get that bill off of and then that's the forced depreciation that we're doing.
Yeah, that's the reading between the lines and seeing what's in there because I think people are underwriting now just on calculators. Like they think anybody can underwrite, but if you don't have any skills or don't understand, you're going to miss all the stuff that's between the lines. And that's how you really make the bigger money down the line because you know what's going to scale. And then again, that helps all of your rents go higher, which, increases your income and hopefully happiness of the residents. So you guys maintain the full property management vertically integrated for all parts of the business on these buildings?
Correct. Only for the assets that we own. So I'm not interested in doing third-party management. I think property management is, in my opinion, the most important, least profitable, least fun component of real estate investment, but it's essential to the main part of what we're chasing, which is that forced depreciation. So yes, SNS Capital Group hires our management arm, which is SNS Management.
Yeah, I think that's smart because that's a really tough business. And when you have 150 units managed by an outside company, they're just not as connected as the owner as much as they want to be. There's definitely a lot of skimming and money lost in that exchange, I think, as well.
Mm-hmm. Yeah, and part of it is like that's true. No one cares like the owner. No one's going to operate as efficiently as the owner. But there's also like building. When we're in one market and we have 1,400 units, there is brand recognition. And so if we made the election to do third party management, we have some owner, in a different state that says, just, don't put the new roof on yet, patch it with some shingles that are a different color, right?
Right. That affects you.
Yeah. It affects the brand overall, whether it's, just unsaid or it's reviews online, right?
Yeah.
Like either way is important to us to maintain that high standard. Because what we do is we buy for long-term, consistent, predictable cash flow. So that usually means we're doing 10-year or longer holds. And how that translates to what you're asking about is like, we are the beneficiary of proper preventative maintenance, or we are the beneficiary of like poor, Band-Aid maintenance. And so we take care of our properties really well, and something we pride ourselves on.
Yeah, when you're targeting properties, are you looking for that? The Band-Aid maintenance is a huge thing, again, because that will give you the competitive advantage to know, like, boy, they didn't take care of this roof, but also you're going to get it for a good price. You know what your costs are. Your costs for construction will be less than someone who has to hire someone out, which is a huge, huge gain on underwriting. What other things are you looking for when you're buying in that 50 units up? The stuff that's between the lines, like a couple of the things that we talked about.
I mean, everything has different shapes, like different. It's like putting together a puzzle, right? Each time that you underwrite, because every deal has different opportunities, or you could have small things as like, are you saying like ways to force expenses down or increase income?
Yeah, or ways that you can use your skill set, like to find the things that maybe just your regular investor who doesn't have a construction background or management background, they're just going to miss those because they're just looking at line items, like you said. There's a lot of stuff I think that falls outside the line. That's how you're able to make good deals and then turn them into good profits.
Mm-hmm. Yeah, I think our ability to underwrite and have certainty in our rent projections is a big part of it. And so someone else might miss it. But when we say we own 8 other communities within 10 minutes of this, and they're all similar, I have the privilege of, when we create our investor OMs now, like we'll have 10 rent comps. In one of the columns, it says owned by SNS, and it all says yes. And so the executional risk, if I went to, say, Dallas, Texas, and said, like, I think I can get $1,800 a month in rent for this unit, it's a little bit of a crapshoot because I'm just basing it off of what I can find online or boards, where for us, we have that competitive advantage. So I don't think it's like profound, that statement, but it's really impactful when you can say to the underwriting, say to the investor, we can move these rents 26, 27, 40%. And here's why we believe that. Yeah. And here's hundreds of units where we've already proven this out on. But even, a simple one is, we know we have enough data to say we expect water usage to be roughly, for a 2-bedroom, about $55 per unit per month, right? And so you can quickly underwrite and see, like, okay, well, here, this property is about $80 per unit per month. The toilets are leaking, right? They're not fixing this stuff, or whatever reason, there's a problem. And as long as we find it, we'll be able to shed that expense and force value into these properties. And so I wouldn't say it's all that complicated. My boiler example is kind of complicated, but usually it's quite simple. And it's like just enough of those little components start adding up.
Yeah, it's such a huge advantage to have the other units, because, as you were saying, your rental comps are rock solid. You're really operated almost in certainty because of the other units you have. Whereas somebody coming in as a new person into the Cincinnati market, they're going to use Rentometer or their agent's rental comps are coming up with something, but they may be missing the other stuff that you're saying with water. So I feel like your acquisitions must be very smooth. It's either a yes or a no based on the price, because you know exactly what's going to happen by having everything so close that are all comps, every size, every option you can point to. Well, that building has ones that are exactly like this. Those are all of our comps.
Yeah, Jonathan, I'll give you an example of a deal we have under contract right now. So we bought a building back in 2018, I think, in a specific municipality, and up the street, back in the 70s, the builder built an identical property, right? He just owned multiple parcels of land. And so we bought one of them in 2018. So we have 6 years of operations under our belt, and we have now under contract the other one. So it's the same builder, the same materials, the same floor plans in the same submarket. And so not only do we know what we can get in rents, we know exactly what it's going to cost us to renovate it. And our in-house teams are familiar with like the subtle nuances of renovating this specific floor plan. And so it's so easy for us to then say, here's what we think we can get in rents. Here's how much it's going to cost us to operate it. And here's how much it's going to cost us to renovate it. You mentioned like one of the competitive advantages we have and having it all in-house is, the biggest account that can impact the value because of the trickle down effect is vacancy, right?
Yeah.
So one thing we pride ourselves on, and one of the reasons we have everything in-house from construction, even we have 6 full-time cleaners, right? Like we like to control the entire aspect. And a lot of that's to control vacancy. And so our turn process, because it's in-house, our leasing team has so much faith in our project managers that they're going to hit the date that they input. So really what's happening in practice is a resident gives a notice, whether it's a 30-day or 60-day notice that they're moving out. Our project managers receive that notice. They put the date in of, we know we're going to be able to renovate this in 3.5 days.
Yeah.
So the finish date, our leasing team is pre-leasing to that date. And so, we have, nearly 1,400 units, and we've been driving rents aggressively. And yet last month, our occupancy was 99%. And people might say like, 99%, you need to raise rents. Well, our turnover was acceptable, meaning like our move-outs were acceptable, but our time vacant is just so fast that's how we keep our vacancy so low. So it's just executional efficiency.
Yeah, I mean, you have like not a monopoly, but because you have so many units, like somebody who wants to be a renter in Cincinnati, they may just be bouncing around between your own properties. So, whereas somebody who owns one building, you could lose them to all the other buildings. You have a lot of options for somebody inside your portfolio for that area. That's where the proximity must really help. And one thing that I was thinking when we were talking about having this new one under contract is, that's definitely attractive to your investors because it's like, you literally know the game plan. But I would think for the seller of that property, it's extremely attractive to have you guys buying that building. You know everything about it. So your due diligence, maybe it takes the same amount of time, but you're not going to go off the rails because you've been managing the replica building for 6 years.
Yes. Yeah. Yeah. It's been very predictable due diligence process. So we say, you know what to look for in that specific thing that we ran into 4 times, down the street. We'll just go make sure that's not going to happen here.
Yeah, but it also allows you to present them the 6 years of evidence that other people are going to find. Maybe they're going to take too crazy, or they're going to know or overreact to. You can say like, we had to replace all of these boilers. This is exactly how much it costs. So we're going to cut that off. You have the models there. It's really helpful.
Yeah. I mean, I talked a few times about expense ratio. It's like identical properties, same area, same school district, everything's match up. We're operating ours at 39% expense ratio. Theirs is at 59, right? So they're out of state. It's just a different efficiency that we bring to the table. And so it's very easy for us to then give that reassurance to ourselves and our investors.
Yeah. And when you guys started SNS Capital, did you decide at the time, like, we're going to stay local, like we're going to be a Cincinnati area acquisition team? And going forward, do you ever plan on going outside of Cincinnati?
No, that's a great question. And so when we made the decision 8 years ago to go into the syndication model, this is a good opportunity to introduce that I have a third partner. So me and my brother kind of started things out, and we're the blue collar kind of operational control, boots on the ground. But Coleman is our partner. He came in kind of around that like 7-8 year mark of our business. And so Coleman is a CPA, has a master's degree in accounting. He worked for a firm that owned about $8 billion of real estate, where he did investor reporting. And so he brought in like institutional grade background in how to add this arm into our company.
Yeah.
So around that time, what we did is we reached out to that spreadsheet of people who were interested in investing with us. And about half of them said, like, I just want strong yield, give me cash flow. And I was like, well, Cincinnati's perfect. Yeah, this is great. The other half said, give me wealth preservation and a potential for growth. And frankly, the second half was the wealthier half that had more means.
Yeah.
And so what we tried to do, and my brother's formal education was in real estate economics. So he starts looking at different markets, and he's like, Atlanta, right? This is 2015, I think. So he's like, Atlanta, let's go to Atlanta. Let's expand to do 2 markets so we can cater to these 2 different investor pools. And the only way I knew how to open up a market was to move to it. So I packed up and moved to Atlanta.
Okay.
And for 2 years, I tried to buy in Atlanta, and I didn't buy anything. Cincinnati continued to grow and do well. What I learned over that time frame is like the investment philosophy necessary to be successful in Atlanta. And this isn't a right or wrong, but like it has to be more speculative than I was comfortable with, because the economic fundamentals of Atlanta are phenomenal. And especially 2015, 2016, like we weren't wrong, but everyone else agreed with us. And so they were willing to pay for it. And I brought my background in underwriting and valuing properties from Cincinnati to Atlanta. And so I was going more on actuals. It was not working. I had no competitive advantage. It's a bigger market, more competitive. And so what I learned was stay in your lane, do what you're really good at, go where you have your competitive advantage. And after 2 years, I wouldn't say it was a waste, because I made a lot of great connections with people who now invest in us for yield. Like they live in Atlanta, that they can't get the yield that they can get in the Midwest. So it wasn't a waste, but it taught me a lot. And the mistake that I made was I was trying to cater to someone else's investment philosophy, not our own. Yeah. Now I was disciplined enough to never do it. Like I never bought anything, but I didn't realize it when I made the move down there. And so packed up, came back to Cincinnati, and we have just focused exclusively on Cincinnati and really having that operational competitive advantage by being geographically so tight knit. And so I think we'll continue to lean on that until we see some kind of shift in a market, because pricing is so competitive. I don't want to lose my competitive advantage and go outside of Cincinnati. And so if anything, we might go to like our neighboring sub markets, call it like Dayton or maybe Indy. But I think that's going to be 5+ years down the road, because there's 70,000 units in our market and there's plenty more for us to do here.
Yeah, I think that's really smart. And I think from an LP point of view, when you're investing in syndications, you really want somebody who's locked in on the market. So again, just like as we were saying before, with you being pretty much sure of what the rents are going to be, so you can really be very predictable about the outcome, that's much more attractive to your investors who are coming in, because they know that you have the metrics to support. Whereas if you go, hey, this is our first one in Atlanta, I don't know that I want to sign up for that. Maybe even if I've gone with you for a few times, I'm not sure that I want to be the test case for a new market. Inside the state, I'd be comfortable, because it's like you're just expanding. It's not going to be that much different. Maybe there's a learning curve. But if you were on the LP side, would you agree with that? It's like being local is really important. It's very hard for me to look at a syndicator and be like, they're in 7 markets. And I feel like I'm going to be the one that's going to fail.
Yeah. I mean, you have to always ask, like, if you're an LP, what is the GP bringing to the table, right? Like it's a partnership. You better have a good way to answer that as the LP. And I have a very good way of answering that in Cincinnati, and not as strong of a way of answering that in any other market. And so, I think
really good testament to you, though, to go down there for 2 years, really hungry to open a new market, but to not pull the trigger, because I think a lot of people, especially now, they get kind of like desperate for properties, or they feel like, they have a little FOMO, everybody's growing. How did you control yourself? Was it just that the numbers didn't work and you're really good on the numbers and it just wasn't going to work? Because other people will pull the trigger because they decided, hey, I want to go and invest in Atlanta. They're going to buy something, but you didn't.
Yeah, I mean, I had really challenging moments of that, right? Like there was like, I moved down here. I've been here a year.
Right, I have to get something. Yeah,
I'm underwriting deals and I'm building relationships with brokers and doing my best to gain that traction. Ultimately, I chose the more disciplined route, because there was plenty of times where I'm in best in finals, or I have this opportunity and I could stretch just a little bit more to get the foot in the door, and I never did. And it was always like I was being pulled in both directions, right? Like I know my disciplines, I know how to underwrite, I know what's right and wrong, but yes, you want to do what you set out to do. And so, I would be lying if there wasn't plenty of times where I was sitting down there thinking like, I got to get this done, right? Yeah. But, I didn't.
Yeah, but don't you think now, with all these units behind you and all of your experience in the business, I know this for myself, that I feel like I'm much more comfortable having properties like, I missed that one. Like, I chose not to do it. Somebody else crushed it. Good job by them. Than having one that screws up your entire portfolio.
Yes. Yeah. I feel very grateful for the position I'm in and where we're at, and that makes that statement a lot easier to have, right?
Yeah, of course.
But when you're just getting going, I empathize with all of the people who have less units and are kind of at those sticking points where you're like, I have 400 units and I'm wearing all these hats, and anytime someone quits, it's like catastrophe, and so you're trying to gain that traction, and right now it's just a really difficult time to do that. I feel super privileged because not only did I enter at probably the best time ever, where we're at right now is, we have 1,400 units, all geographically really close. We have the org chart to kind of support the back end operations while giving me the flexibility and freedom that I want and set out for. But I don't have a ton of overhead like acquisitions people. I don't have investor relations people. Like we're at it's nothing against that. I think we will get there. But we're at this sweet spot where I can also be super disciplined and say, like, if we don't buy anything for 2 years, that's fine, right? Like, because what we already own is supported, but I don't have a ton of overhead forcing me to make acquisitions. And so I just feel really good about the spot we're in, which makes it very easy to say, it's okay if we miss that one, right?
Yeah. And now with all your time in the same market, I assume people know you guys. So it's not like you don't really have to scratch for deals. You probably get approached for deals all the time. Like, hey, are you guys interested in that? Knowing that you really know the due diligence, fair dealers, you can run the numbers and it's going to be a win-win both sides. Is that what's happening now where acquisitions, especially at the large scale, you're probably going to know about them in Cincinnati anyway?
Yeah. Yes. I mean, you build that reputation of not only being one of the largest owners in the market, but also like being a good buyer, right? A lot of times at our scale, they're represented by real estate brokerages or real estate brokers. And so in our market, that gets boiled down to like 5 real performers in the real estate brokers. So so like we have strong relationships with all of them. And we talked about that operational efficiency and being able to operate at such a tight expense ratio. The brokers love that too, because they say, here's that upside, that margin that, at times we're willing to pay a little bit for, and another group might not be able to have that confidence or that efficiency. And so it's a win for the brokers when they say, we know SNS can pay our target because it's going to make sense for them because they're more efficient. And so, yes, that allows the acquisition pipeline to be a lot easier than it used to be.
Yeah, I think one thing that newer investors just don't know, and some people who are growing really don't get, is that your large scale commercial brokerage or brokers, it works much differently than residential and small scale multifamily. It's always a who you know game. A lot of the stuff's not going to hit the open market. And as you were saying, a broker who knows you guys well and sees an asset that works, and maybe you've done a deal together, they can really dial up the due diligence so it's exactly what you want. The numbers work both ways, and it's just a win. Because the win on larger assets, you're selling 100 units, is you sell it to a good buyer who's going to close at a price that everyone's happy with. It's not like, residential where there's 10 people bidding on it to see who's going to get it for higher. That doesn't matter. You need a closer, right?
Mm-hmm. Yeah, I mean, I'll give you an example. In October of 2023, we bought a 150 unit deal here in Cincinnati, and we paid $16.5 million for it. And through conversations with the real estate broker, there was multiple offers over us, and one of them at 18 million. Right. And so to your point is like that seller and that real estate broker who was representing them made the decision that the assurance of closing and the predictability of the transaction was worth $1.5 million. Like that, that's a common occurrence. And that's how these transactions work.
Yeah, I think that's really, though, important for people to know as they start going up. Even really 20 units and up, it's going to be pretty similar because those are going to be commercial brokers. You still get some residential brokers who are listing, in the like teens because they still feel like small apartments. But it really is. You can't just fly in blind. They know if you've done your due diligence and you're at 1.6 and someone comes in, 16 or 16.5, someone comes in and offers 18, they haven't done the due diligence. So they're going to come back with some crazy requests, and they're going to be looking for things instead of knowing like, nope, they know the area, they know the building maintenance, they know the costs. Like when they say this is a deal, they've already done it. Like we're good to go. That's huge.
When we submit an LOI, there's a whole section, a letter of intent to kind of express our interest in making the purchase. There's a whole section in our LOI highlighting all the bad things we already know about the property.
Yeah.
So, we say here, we know about this problem with the plumbing. We know about this issue that you have with residents. And so it's kind of like, oh, okay, well, we don't have to worry about that. They made this offer, whatever I'm seeing in the LOI, with eyes wide open.
Yeah. The other LOIs are just going to be a number.
Yeah, right.
Yeah, that's a big difference, and presentation matters and the relationships matters. So where do you guys want to take the business now? You've obviously grown it over the last, 10, 15 years to a great amount. And I like what you said before, you don't have to acquire something in the next 2 years because what you're doing is great. But what do you think the next 5 years look like for you guys at SNS?
Yeah, I think a lot of companies will answer this with like percentage of unit or number of units growth, or maybe percentage of revenue growth. And I think those are good targets, but it's not really how I direct our company. So instead, I'm more process focused. And that's how our company just runs, is I say, we'll have this many conversations with real estate brokers. We'll have this many in-person meetings with real estate brokers. We'll have this many direct to owner conversations so that our reputation is increasing. And so it's all about the process of how do you fill the lead funnel. And if we do all of those processes and buy nothing, that's totally fine.
Yeah.
If we do all of those processes and it results in us buying, 12 a year, I feel we have the operational capacity to handle that. And so that's kind of what I see in the future is highly dependent upon what our actions will be able to produce. And so I don't want to point the finger at the market and say it depends on what the market will give us. It really depends on what our actions will give us. But if it gives us nothing, then we won't grow. And I'm totally okay with that.
Yeah. Yeah, I love that. I mean, I think that generally, if you're doing the same things that you want to, that are going to be good for the long-term business, you're just waiting for the deals to percolate when they do. And if you have the mindset like you do, as I don't need to acquire one now, if something presents itself, then the numbers work, we can handle it. You're in a much better spot than everybody else who's scratching to acquire something.
Yeah. Yeah, it's a privileged spot to be in. And I think it's a combination of things that have gotten me here, right? Like I mentioned before, when I started, I also started very young. And so like I do have a significant runway ahead of me. And so that gives me like the feeling of like I can take my time and be patient and make wise decisions. And I mean, we've had the wind at our back for 15, 16 years. It's been a very, very beneficial period for me. I don't want to jeopardize it by, pushing it too far.
Yeah. Awesome. Well, where's the best place for people to get in touch with you guys at SNS? Let me just pull this up. I think it is snscapitalgroup.com.
That's it. That would be the best spot.
Yeah, and they can go there, find about what deals you have going on, and that's where they can also invest in syndications, correct?
That's correct. I think there's like a contact us as well, and I think those will make it to me. And so anybody who needs anything, they can get in touch with me there.
Yeah, awesome. Before we hop off, I see this on the site, Why Cincinnati? And that's what I wanted to ask you. Tell us why obviously you're there, but why is Cincinnati such a good market? It definitely is a market that comes up on all sorts of investor lists. And it seems to me like there continues to be very good scale in a lot of parts of Ohio, but Cincinnati just keeps going and it shows no signs of really retracting at all.
Yeah, for those who are not as familiar with it, I would say for my whole investment career, up until 2 years ago, Cincinnati was labeled as a stagnant market. So like it's kind of like 2, maybe 3% growth.
Yeah.
And it's like just chugging along at a linear path when the Sun Belt is just like on fire. So
it sometimes gets caught on fire though as well.
Yeah. So, and then 2 years ago, I kind of started hearing it's now we are a stable market. So the question is like stagnant or stable. Which one do you like? I'm okay with either because our investment philosophy is consistent, predictable cash flow. So the Midwest and the market that I know best, Cincinnati, really caters to that. I could go down the rabbit hole of like population growth and economic fundamentals and all those things, which I think we are average at, right? And that's kind of plays into that stable, consistent, we're not declining, we're not alarming, but we're not shooting up. And for me, that's what I like. And so that's why I'm really attracted to Cincinnati. On top of that, I'm born and raised here. I built my company here. I have that competitive advantage, and that's what we lean on really heavily.
Yeah, that's awesome. And I do think for even people getting started and moving bigger, clustering properties near each other in any context, whether it be single family, multifamily, if you're doing short-term rentals and other things, it's always a good idea because you're streamlining management. That's been one of the biggest things for you to be able to grow, is that you can hire and that all of these properties are at least in good proximity to each other, which keeps your costs down, right?
Costs down. And I think we all know this, but it doesn't get said enough. Like we all listen to these shows and we pursue real estate investment for the financial returns. But financial returns are clearly supported by on-site operations, and on-site operations are supported by the people who work there. And so when you're geographically close together, you just have more staff to be able to handle problems and produce the outcome that we're, targeting, which is the financial returns. The more spread out you get, the more rocky that kind of workflow becomes.
Yeah, that's when people are like, oh, this is my side job. No, now you have, 3 jobs because you can't keep up and you're in different markets managing it all.
Yeah.
Awesome, man. Well, I really appreciate your time. It's a great episode, and I appreciate you coming on the show.
Yeah, Jonathan, thank you so much. Anyone in the background who does producing and stuff, thank you for that too.
Yeah. All right. That was Jered Sturm of SNS Capital Group. I'm Jonathan Green. We'll see you next episode. Wait, you have reached the end of the show. This is the part where you're going to get ready to check out, but I've actually changed this part. For over 120 episodes, you heard the same thing. Well, now I've changed it. I've thought about doing intros to the next episode, but I'm going to hold off on that for now. These are my pitches at the end. I've got nothing to sell you at all, but I do want to remind you that it really would help us if you support the podcast in the right way. All that means is subscribing to the podcast so you get it on Monday and Thursday, writing us a 5-star review if you believe that we deserve a 5-star review, sharing it with your friends, and being a participant in the Zen and the Art of Real Estate Investing community. Soon there's going to be a new website launched. Maybe when you're listening to this, it's already going to be out there. That's where we're going to have collaboration. You're going to be able to see a lot from the guest. It is coming soon, and I just want to tell you, from me to you, I don't know how I got here, over 100 episodes. I'm so appreciative of you listening to the podcast and especially sticking around to hear this part. We'll see you next episode.